Can the average investor really outperform the wizards of Dalal Street? The answer is yes. Welcome to the Financial Talk. Today, our team is breaking down the legendary investor Peter Lynch's playbook, Beating the Street. We are decoding his golden rules for stock picking and the exact strategies he used to make history. Hello everyone, I'm Mohit Sani. Today, I want to end this debate whether to buy stocks or bonds. Let's start with the hard truth. Do you hope to have more money tomorrow than you have today? The obvious answer is yes. For that, you must put a significant chunk of your money into stocks. I know what you're thinking. What about the next bear market? What about a recession? The 20th century was full of bear markets and recessions, yet the results are indisputable. Sooner or later, a portfolio of stocks will outperform bonds, FDs, or money market funds. But you don't have to take my word for it. Let's look at the data. Let's look at a scenario analyzed by Mr. Lynch where the bonds are paying 7% interest and the stocks are paying 3% dividend and appreciate at the standard 8% a year. In case A, the entire 10,000 is put into bonds. In 20 years, the owner of this money will receive 14,000 in interest income and get back his or her original 10,000. In case B, the 10,000 is divided 50-50 between bonds and stocks. The result is after 20 years, the owner receives 7,000 in interest income from the bonds plus 6,864 in dividend income from the stocks and ends up with a total portfolio with 23,864. Whereas in case C, the entire 10,000 is put into stocks. Here, the owner gets 13,729 in dividend income and ends up with a total portfolio value of 46,610. Isn't that truly amazing? Now let's talk about those of you who need income. Conventional wisdom says if you need to live off your money, you buy bonds. That's a dangerous advice. Let's say you have 1 lakh and need 7,000 a year to spend. If you put that 1 lakh into stocks with 3% dividend, you only get 3,000 in cash for the first year. You have a shortfall. So you sell 4,000 worth of stock to pay your bills. It sounds risky to sell in a loss, right? But if the market grows at its historical average, by the second year your dividends go up, so you sell less stock. By the 12th year, the dividends alone cover your income. And at the end of 20 years, despite withdrawing income every year, the original 1 lakh has now grown into 3,75,743. You are nearly 4 times richer than where you started. But what if the market crashes? This is where psychology beats intellect. As we say, it isn't the head but the stomach that determines the fate of the stock picker. Imagine the day after you buy that portfolio, the market drops 25%. Overnight, you feel like you have gambled away. But if you hold on, the math shows that 20 years later, the portfolio is still worth 1,85,350, nearly double the value of money of your bond. If the math is so easy, then why don't all analysts become rich? There's a difference between a successful investor and an analyst. He might be good at reading balance sheet, cash flows, but that is not the ultimate requirement. A person having a strong stomach, that is the gut to hold stocks at bad times, is the one who will truly succeed. See, all the information is available out there on the internet, but only few investors make it through. Why? Because it is the gut that matters the most. To achieve these results, you need to follow a few rules. First, never invest in an idea you cannot illustrate with a crayon. You should be able to explain a company's story to a fifth grader in about 90 seconds. If you can't do it, don't buy it. Secondly, diversification. Out of every 5 stocks you pick, one will be great, one will be really bad, and the other 3 will be just okay. You need that mix. And third, don't water the weeds. Too many investors sell their winners to hold on their losses. That is pulling out the flowers to water the weeds. However, there is one technical exception to watch out for. If the yields on long-term government bonds exceed dividend yield of Nifty 50 by 6% or more, that is the time to sell your stocks and buy bonds. If all of this research, crayons, and the stomach check sounds like too much of work, there is a solution: equity mutual funds. They are the perfect answer for those who want growth of stocks without the homework. But how to determine a good mutual fund? Don't spend a lot of time poring over the past performance. That's not to say you shouldn't pick a fund with good long-term record. But it's better to stick with a steady and consistent performer than to move in and out of funds trying to catch the waves. Do your own research or hire a fund that does. But whatever you do, don't sit on the sidelines. I now call Mr. Tariq to share his learnings from the book. Thank you.
Now, let me tell you why is it very important for the investor to be very careful with the hot sectors. Now, whenever the market stories that there is a huge growth potential in a sector, or whether there is very huge or very high growth potential in a sector, the herd mentality of investor starts to play. Many of the investor faces the herd mentality. Now, what they do is that they starts to buy this sector because they don't want to miss out on the growth opportunity, and sector becomes very popular. Now when the sector becomes very popular, the investor starts to buying it, and the valuation rise beyond the fundamentals. And when valuation rise, there is a very low upside potential for the returns. And even in a market correction happens when the investment starts to hamper. Now, how can we avoid this hot sector? First of all, let's say if I am an investment manager or a fund manager, my competence revolve around cement, pharma, or FMCG sector. Now, if there is a very huge upside or very huge high growth potential going on in IT sector, which is not my competence. First, I have to develop competence in the IT sector, and then I have to see whether the opportunity is good or not. I have to focus on the fundamental. If there is a huge growth potential, how is it going to bring me the revenue? Is the price justified or not? So this is the one thing. Now, my second learning is that how investor panic hurts an open-ended fund. Before that, let us explain there are two types of mutual fund. One is the open-ended fund and second one is the closed-ended fund. Now, what happens in open-ended fund is that whenever the investor wants his money back, he goes to the fund house and redeem his shares. Now what the fund manager has to do is give his the money back, either by the fund's cash or from his selling his position from the stocks. Now, in closed-ended fund, when the investor demand his money back, he can directly sell those units or from the mutual fund to the market. So that is the stock exchange. Now let's focus on the open-ended fund. Now what happens when there is a panic-like scenario or a correction or a crash going on in a market? Investor gets panicked and he wants his money back to be on the safer side. He wants to revolve his money, let's say in a gold or whatever he considers as a safe investment. He demands his money back. Now fund manager has to fulfill this requirement. He has to sell his position of good stocks, or let's say he has to give the cash. Now, what happened from the fund manager perspective is that there is a very, let's say, a huge potential going on in the market. Why? Because the stock is available at a very bargain prices because there is a recession going on, and the fund manager has to miss on those opportunity, which leads to hamper the growth of the fund, and investment returns are very low of the fund manager. So that is the reason we should not panic and stay consistent over the years. Thank you. Now my colleague Saurav will take over and explain his key learning points from the book.
Hello everyone, I am Saurav and I am going to present to you two, three topics from the book which I thought were important. So let's start with the first one, Blossoms in the Desert. It refers to a great companies in the lousy industry. The investment strategy, it favors to invest in lousy or non-growth industry where in tough competitions, many weak players exit and those who survive tend to capture more market share. Now, one of those example in the book was Southwest Airlines, a best performing stock in 1980s decade. Even though at that time, airline was considered as the worst industry, mainly because of high price competition, higher debt, and more bankruptcies. So, what were the main reasons that led Southwest Airlines to be a survivor or the great company? So, first and most important was the low cost operator. Now, Southwest Airlines had operating cost per seat mile of just 5 to 7 cent, where the industry average was 7 to 9 cent, mainly because Southwest didn't give free meals and they had just 4 to 5 planes. So the training cost was also very low. Second, the frugal management, the decent pay at top level, and no corporate luxuries. So these were the measures they took to control the cost while others didn't. Third, motivated employees. This led to faster turnarounds and lower absentees. Fourth, they had niche. While other competitors and other airline companies, they flew wide bodies and long distance. Southwest Airlines called themselves the only high frequency, short distance, and low fare airline. And when the competitors were struggling in their financial conditions, at that time Southwest expanded its routes and captured the market share. So this is how Southwest grew from just 4 planes to then eighth largest aircraft in the country, and it saw 10x jump in the stock price in just 5 years. And just to state one example, as per Indian context, sorry, it's VST Industry, a cigarette manufacturer. Let's go to second slide. Some important metrics. So Mr. Lynch emphasized that it is important to understand the company's product and industry, but it is also more important to analyze company's balance sheet to assess its ability to remain solvent in tough time. So he mentioned 3-minute balance sheet drill to check some important metrics. So the first one was equity value. So in equity, reserves should be the highest contributor. If it is that, then equity is considered strong. It should be not like consistent equity issuance. Second, goodwill. At time of acquisition, when we acquire a company, we pay over and above the book value. That is goodwill, and higher goodwill as percentage of total asset is not a good sign because the write-offs of goodwill will directly go on P&L and negatively affect the net profit. Third, debt to equity. In the book, they have mentioned for retail industries or retail companies, it should be less than 0.5, 0.5. And generally, for industry to industry, it varies, but generally it should be less than 0.8 so that in tough time, they have enough equity or assets to sell them and pay their debt. Now, last and important, working capital. Less working capital means less money stuck in the day-to-day operations, means the profit is efficiently converted into cash. So this was it from my side. Now I will pass on to Bhumik. He will explain later. Thank you.
Hello everyone, myself Bhumek Jain, and here are some of my learnings from the book Beating the Street by Mr. Peter Lynch. Let's start with insider buying signals confidence. Insider buying simply means company employees are using their own money to buy shares in that company. This shows they have confidence in the company's future and believe that the stock may be undervalued. They don't know the most about the business and what's happening inside the business. So when they put their personal capital at risk, that's a meaningful signal. The signal becomes much stronger when multiple insiders are buying. If several key people, not just one, are purchasing shares, it indicates stronger conviction across the management team. It's no longer just one person's view. Timing also matters. When insiders buy after the stock has declined, that's contrarian confidence. They're effectively saying that despite market pessimism, they believe the company's fundamentals are still intact and the market is mispricing the stock. Insider purchases also create alignment. Once key employees own a meaningful amount of stock, their personal wealth is directly tied to company's performance. That alignment gives them a stronger motivation to work harder and make the company successful because they benefit alongside outside the shareholders. But before acting on insider buying, a few checks are essential. First, ask, is the buying a one-time event by the insiders or has it been repeated over the past as well? A single purchase may not mean much. Repeated buying over time shows more durable confidence. Second, ask, do the fundamentals support their confidence? Insider buying alone is not enough. You still need to look at the business, its sales, its margins, its balance sheets, and prospects to see whether the story holds up. That's why the reminder on the slide is critical. Insider buying is not the same as the buying signal. Always validate the fundamentals of the business and ask yourself, would you invest in the business if based only on the fundamentals? If the honest answer is no, then move on and don't invest based on the insider signals only. Now let's talk about evaluating retail companies. Retail companies are unique in investing. You can literally walk into a store and see the business working or failing right in front of you. That transparency is why Peter Lynch liked retail stocks. They're easier to understand. First, we look at the same store sales growth and we ask, are the current store sales growing? If the existing stores aren't growing over year, and opening more stores won't fix the problem. This is the most basic indicator of the health of the business. And if they're not growing, try to understand the reason. Second, check if the expansion is realistic or not. Is the company expanding quickly or slowly but steadily? Mr. Lynch specifically warns against chains that expand too fast because rapid expansion often hides underlying problems and stretch management and finances. So it's not just about adding locations, it's about whether the pace of expansion is sensible and sustainable. Third, evaluate the balance sheet. See the strength of the balance sheet. Is the net debt zero or below or small? Is the cash conversion cycle, the EBITDA divided by CFO before taxes over the years above 90%? Is the company mainly invested in core assets and not non-core assets? Is the equity healthy? By equity healthy, I mean, is the equity mainly comprised of retained earnings or is the share capital the higher portion? Fourth, study inventory health. Is the inventory building up compared to normal levels? The normal levels being based on previous past, how the inventory levels have been. And if it is increasing, try to understand the reason. Is it because the company is expanding? If it is, then it is fine. But if a stock is piling up faster than sales, it usually signals trouble ahead. Finally, think about valuation. Is the PEG ratio 1 or below? Comparing price to earnings with growth helps you see whether you're paying too much for that growth. That's why in the example on the slide, the Body Shop with its growth and PEG ratio delivers more growth per unit of valuation than Coca-Cola. You aren't just looking at a popular brand, you're weighing growth against the price you pay. Thank you.
Now let's understand cyclical stocks and how to apply buy low, sell high framework using General Motors example. What are cyclicals? Cyclical companies are business whose performance moves up and down with the economy. They include automobile, airline, steel, cement, and chemicals. When the economy is strong, these companies enjoy very high profits, but when the economy slows down, their sales and earnings fall sharply. Because of these swings, timing is extremely important in cyclical investing. Peter Lynch explained that in cyclicals, the PE ratio behaves in reverse. When a cyclical company shows a very low PE ratio, it often means earnings are at their peak and the downturn is coming. This is usually a sell high zone, not a buying moment. When a cyclical shows a high PE ratio, it can mean the company is at the bottom of the cycle, earnings are depressed, and the improvement is ahead. This is often the buy low stage when most of the investors are scared. So in cyclicals, you do not buy when the things look perfect. You buy when the current results look weak, but the future conditions are improving. Before investing in cyclical, we must check few things. First, industry position in the cycle. Where is the entire industry right now? At the top, at the bottom, or turning upward? Second, balance sheet strength. A strong balance sheet is essential because cyclicals must survive downturns. So always check sufficient cash and the low or manageable debt. And for this, check CFO to debt ratio. And third, product demand. Look at inventory levels and the demand indicators like vehicle sales data. This guides us whether the real recovery is coming or not. With these checks, you avoid guessing and instead understand where the company sits in the cycle. Now let's put all this idea together with the example of General Motors. GM stock already rose 37% early in the year. Most investors would have think it has ran up too much, it's too late to buy. But Peter Lynch looked deeper, using the same factors we just discussed. Lynch studied the vehicle's actual sales and the estimated sales data, which showed that the sales were still millions below the long-term trend. It can be seen from the table that in 1983, around 9 million people postponed their plan to purchase vehicle, and from 1984 onwards, actual vehicle sales remained higher than expected vehicle sales. This means auto demand was still depressed and the industry was just entering the recovery phase. Lynch also supported his study with the macro factors and directly tied it to GM's outlook. The US dollar was falling, making Americans' car more competitive globally. Japan was facing economic and competitive challenges, which reduced pressure on GM and other US automakers. These two factors gave GM extra room to win back market share. Putting all of this together, Lynch concluded that the cycle was still early, the fundamentals were improving, and the GM had still strong upside potential. The key lesson here is in cyclicals, you don't focus on the past price move. You focus on where you are in the cycle and what the future earning potential looks like. To conclude, understanding cyclicals require understanding the cycle. You buy low when the industry is at the bottom and improving, and you sell high when the earnings look perfect and the cycle is peaking. Now I invite Mohit to impart his understanding on current affairs. Thank you.
Hello and welcome back. We will now be updating you on what's really happened in the first half of fiscal year 2026. I, Mohit Saini, will now walk you through the GDP numbers. The economic story of India's FY26 is one of stunning resilience. The economy delivered an astonishing 8.2% GDP growth in the second quarter, a performance so robust it's being hailed as India's 83 World Cup moment. This is not a temporary bounce. It is a structural shift, the result of sustained policy reforms finally creating a higher, more durable growth trajectory. Let's put the numbers on the screen. The RBI is projecting robust 7.3% growth for the full year, a 50 basis point upgrade from the earlier projection. This bullish sentiment is based on three domestic engines. The first one being domestic consumption is king. Recent tax cuts and the ongoing successes of GST reforms have acted as a powerful stimulus, putting more money into the hands of consumers. Strong private demand is quite simply the primary growth driver. Second, broad-based sectorial strength. The power behind 8.2% is how broad-based it is. Manufacturing was a standout, surging to an incredible 10% growth, a clear indicator that the PLI schemes are paying off. The dominant services sector led the charge, primarily financial and professional services expanding by a massive 10.2%. Crucially, construction expanded by 9%, reflecting the continued aggressive push on the infrastructure. We must note that this is overwhelmingly private driven growth. Third, a supportive policy environment. Falling inflation has given RBI the necessary space for accommodative monetary policy, including anticipated rate cuts, which further facilitates investments and economic momentum. To conclude, India's FY26 is said to be a year of sustained high growth. This is a powerful indicator of structural transformation, firmly establishing India as an economic powerhouse. I now request Tariq to take over from here.
In the past 5 years, the big tech has spent around $1 trillion on AI, which are far exceed the oil and gas capex. We can see in the bar graph data that over the year, the AI has far exceed the capex of oil and gas industry. I have only taken five top AI companies and five top oil and gas companies. Now, the next thing is if we are doing the capex, naturally it becomes a hot sector because everyone thinks that there will be a huge growth potential going on. That is the reason that a company is doing the capex. Now, everyone is rushing to buy, which makes it a very expensive sector. Like we can see over here that the earnings, that is the PE ratio, is at 38x, which is very huge, which is well above the traditional sectors. Now, if the capex are being done, at a huge amount of capex being done, is it sure that we are going to get the revenue which is being forecasted by the management? We never know because this is a innovation going on. Sometimes innovation fails, sometimes innovation pass, and sometimes it disrupt the economy like anything. Like if 20 companies are racing for innovation, only 5 get success. The rest 15 disrupt the capital. So we have to be sure about that. And the third thing is that the structural and operational risk. The AI company uses data centers. These data centers require a huge amount of power. Naturally, the power is limited in resource. So we have to see where are we going to get the power. And the third thing is that the data theft is going on, which makes the government to include a regulatory constraint on it, which may hamper the growth. Now my colleague Saurav will take over and explain his key learning points and on the current market.
Let's talk about inflation. So back in January 2025, the consumer price index inflation was around 4.3% in the acceptable range of RBI of 2 to 6%. But in October, it fell below 1% at 0.25%. The main reason was the low inflation in food and beverages category. Now, this category contributes about 45 to 50% in the CPI basket. But if we exclude the food and beverage category and fuel category, which are not under our control, so the core inflation comes around 3.85%, which is still in the stable range. So let's now talk about interest rate, what happened there. Now in 2025, total repo rate cut was about 125 bips. The repo rate reduced from 6.5% to 5.25% latest. Now, then CRR cut was of 100 bips from 4% to now 3%. Now, this was done to increase the money supply because the inflation was low, under control. So we had a higher room to grow. Then they infused about 2.5 trillion rupees in the system, mainly because to reduce the MCLR rate and certificate of deposit rate so that banks can borrow cheap. Now, what was happening in the credit deposit ratio was that deposit had a slow growth of about 9.7% YoY, mainly because of the lower repo rate and lower that led to low deposit rate, and the deposits were now shifting to mutual funds as they were giving more return. Then credit growth, it was strong at 11.3% YoY, mainly because of corporate capex recovery and higher consumption spending. So this resulted that credit to deposit ratio above 80%, where the RBI's safe range was 75 to 80%. Now here, banks are walking on a tightrope where the deposits are low, they are falling, whereas the credit demand is increasing. So let's see what happens next. But now I will hand over to Bhumik.
Hello everyone. Now let's talk about the PLI scheme that the government has recently announced for the rare earth magnets. In November 2025, India's cabinet took a strategic decision that could reshape the country's manufacturing landscape, approving a 7,280 crore PLI scheme for rare earth permanent magnets. India today is almost entirely import dependent for rare earth metals, even though the demand from electric vehicles, renewables, industrial equipment, and consumer electronics is rising sharply. The government expects this rare earth permanent magnets demand to double by the year 2030. This new PLI tries to change that by financing integrated manufacturing facilities that cover the whole value chain, like from processing rare earth metals into oxides, then those oxides into alloys, and then finally alloys into the finished magnets. The outlay is about 7,300 crores, targeting 6,000 tons of annual magnet capacity. The current demand for the rare earth permanent magnets is 5,000 tons. Why does this matter? Let me break it down to you in two critical areas. First, in EVs and wind turbines. These magnets sit at the heart of the electric motors and generators. With rare earth permanent magnets, you get motors that are smaller, lighter, and far more energy efficient, meaning EVs have better range and wind farms generate more power. Second, aerospace and defense. Rare earth permanent magnets are used in high precision systems, guidance systems, actuators, and sensors. that must work reliably even at extreme temperatures and under intense vibrations. Thank you. Now, my colleague Uttam will continue.
Now let's look at the updates on tariff. In August 2025, US put new tariffs on India because India was buying cheaper oil from Russia. This created a chain reaction. Indian exporters suddenly saw fewer orders coming from the US and the business confidence started to drop. By November, India's manufacturing activity slowed down and the PMI fell to 9-month low, mainly because companies were worried about the US tariffs. At the same time, the tariffs also hurt American customers. Prices of groceries and daily items become higher, so the US government had to roll back some food-related tariffs to reduce inflation. But the main tariffs that affected Indian goods were still there. Because of this, Indian companies began searching for the new buyers in other countries in the Middle East, Africa, and Southeast Asia, so they wouldn't depend only on the US. Government also introduced 45,000 crore scheme to support exports. GST reforms also helped to negate some of the tariff impacts. Now let's understand some of the significant changes in economic data. We can observe that the difference between the nominal and real GDP growth has been shrinking. The key reason for this is low GDP deflator, which itself reflects the current low level of CPI and WPI. You can clearly see the impact of GST reforms in the strong rise in cars and two-wheeler sales. The recent GST rate cuts have also influenced e-way generation, which reflects the stabilizing effect of these reforms on trade. This suggests that the changes in e-way bill numbers are driven by GST adjustment rather than a real economic slowdown. And in some sectors, exports suffered due to tariffs. Also, imports rose due to the high value imports of the gold. I hope you have learned something from us. Thank you for watching to us.